Hello, ladies and gentlemen. Today we're going to be addressing the question, is a financial crisis around the corner? My name is Lee Boon King, and I'm Associate Professor at Nanyang Business School in NTU. Before we can answer that question, we first must address an even bigger one, and that is inflation bad? So if you look at this illustration, you can tell that inflation is not necessarily bad, provided if it doesn't get out of control. A little bit inflation is good for the economy. Slightly more may not be so good, but if inflation does get out of control, then it will be bad for the economy. Okay, let me show you how that works. With an increase in price, your purchasing power will fall. To compensate for that, you're going to be asking for higher wages. And when higher wages are given by the companies to you, profit starts to fall. And in order for companies to maintain that profit, they're going to have to pass that higher cost to consumers, and prices will increase again. And ultimately, you get into this wage price vicious cycle. And if that cycle is not arrested, if it's not stopped at some point in time, cost is going to be more than revenue. Companies will start to lose money and they will stop investing and start to fire workers, and you get into a recession. Okay, let's come back to the present day. I'm going to share with you the sources of high inflation starting from 2020. Clearly, the pandemic has caused great supply disruption, and that has led to increase in prices. Now, in order to alleviate the impact of the pandemic, governments and central banks around the world have injected tremendous amount of money into the system, and that has caused a massive positive wealth effect that provided consumers with tremendous amount of spending power and leading to a lot of spending with very little supply, and that again added the pressure on inflation. The third reason for that high inflation stemmed actually from a few years before that, and that came from that Sino-US trade tension. And of course, that trade tension meant that the biggest exporters around the world all of a sudden, right, find themselves not able to export as much as they want to. And that also caused an increase in prices. And more recently, what we had was a high oil prices caused by the geopolitical turmoil, especially the invasion of Ukraine. Right? That has also resulted in high inflation. But today, I'm going to talk about the second point, which really is the wealth effect from this massive monetary and fiscal stimuli. If you look at this particular illustration again, you see that huge amount of spending created that inflation, and it's very difficult to control that inflation if you keep pumping and pumping more spending into the system. Let's look at this chart. You notice that the Federal Reserve has been pumping a lot of money into the system, and that's represented by the blue line. Since 2008, to solve the global financial crisis, the central bank has gone on quantitative easing, and during this pandemic, they have gone on hyperdrive. A lot more has been printed. And to add on to that massive wall of liquidity that the Federal Reserve has sent into the system, the government has provided the COVID relief plan that added on top of that a lot of spending. Okay, you notice that every time the central bank pumps more money into the system, and when the government piles on top of that, the S&P 500, represented by the red line, has increased and has gone up significantly. So that clearly is a sign that the Federal Reserve and the government of the US has created this massive wealth effect, causing a significant increase in asset prices. Now, how much money have developed countries actually printed? A lot. Ladies and gentlemen, a lot. So let me show you this chart. If you look at the red line, that's Japanese, right? That's the Bank of Japan, right? Bank of Japan has printed as much as 130% of its GDP. That is followed by the ECB, and you're talking about somewhere around 70%, followed by the United States, that is about 40% of its GDP. That's massive amount of printing. But if you look at the speed at which they're printing, the US has gone on hyperdrive, right? It has gone from just slowly raising the amount of money that they print back in the global financial crisis in 2008 to where it is today, a massive amount of money that's printed, right? And at very fast pace. So what has clearly resulted from that is very tight labor market. A lot of money goes out there. There's supply chain disruption. There is high demand. And as a result of which, the labor market gets tight. And because of the pandemic, because of the way that people have changed the way they work, you notice that over a period of time, there is this thing called the mass resignation. And if you look at the chart, you can see that very evidently, right? The blue line shows the quit rate. That means how fast workers in the United States are quitting their job. During the pandemic, there's a sharp spike in quit rates, right? In other words, people are maybe feeling that they ought to look for another job. Labor market is tight. They have higher bargaining power. They look for another job and quit their job, right? Looking for better opportunities. And that has caused wages to increase. And if you look at that red line, that's how much has increased. Wages is now increasing at a rate that is the fastest for the last 20 years. And of course, with higher wages, you're going to see a lot more spending. And labor market getting tight, wages getting tight. Remember that wage price vicious cycle I was talking to you about? We're seeing it right now. So clearly, the Federal Reserve has sent a massive wall of liquidity into the system. And that has fueled rising prices. Now, does it mean that we are not in that wage price vicious cycle that we're talking about? Well, not quite. Because if you look at this chart, you can tell that wages are at the highest level for many years. And that is because the labor market in the US is getting tight. And the tight labor market came from the pandemic as more workers quit their job looking for other opportunities. Why did they quit their job and look for other opportunities? Because there was massive support, both from the government as well as the Federal Reserve. And that tight labor market has resulted in higher wages. So we are kind of building that wage price vicious cycle. Now, has the Federal Reserve done something to try to arrest that? Yes, to be fair. The Federal Reserve has been raising interest rate for a while and is now at multi-decade highs. Now, does it mean that therefore they will be successful? Well, let's see. If you look at this particular slide, you will see a certain phenomenon happening, right? The lower panel here represents the difference between inflation and expectation and actual inflation. And you notice the following. For the last 30 years, consumers have been broadly overestimating inflation. Now, if you overestimate inflation, you tend to try to adjust your inflation expectations lower, and that will keep inflation somewhat depressed. Now, if you look at the current situation, you notice the following. Consumers have actually been largely underestimating inflation. And when they underestimate inflation, they will start to build inflationary expectation higher. The last time we had that was back in the 70s. And that has created a period of very, very high inflation and ultimately leading the Federal Reserve to raise interest rate massively to kill inflation. So we have addressed the issue of inflation. Uncontrolled inflation is bad. The Federal Reserve has been trying to control inflation. Unfortunately, inflationary expectations are not suppressed yet. In other words, consumers still continue to underestimate inflation, which will lead to higher inflationary expectation. Now, does that mean that we are about to go into a financial crisis? So let me address the issues of bubbles and crashes. As Mark Twain used to say, history does not repeat itself, but it does rhyme. So if you look at the major financial crises in the last 50 years, you will notice that there's a certain rhythm to it. The first one was the Latin American debt crisis in the 80s. That's followed by the Japanese balance sheet crisis in the 90s and the Asian financial crisis somewhere around 2000. And finally, the US subprime crisis in 2008. Now, there is a rhythm to it. If you look at that rhythm, you notice the following. That it starts with emerging markets, then it goes to developed markets, then it goes to emerging markets, then it goes to developed markets, and you could expect that the epicenter of the next financial crisis could be in the emerging markets, just based on that rhythm, right? Now, what are the characteristics of bubbles and crashes? Bubbles are created by pinpoint focus of massive capital inflows. So if you look at the Latin American debt crisis, the bubble was built initially by massive capital inflows into the system because there was nowhere else to invest. And Japan likewise in the 80s, Southeast Asia in the 90s, and again, the US subprime in 2005, 6, around that period. Right? That massive pinpoint focus of global capital into the system, into a particular asset class, would create that bubble. And what burst it? Right? All were burst by tighter monetary policy. Right? So tighter credit condition would have burst the bubble. Are we there right now? Yeah, absolutely. As I mentioned earlier, the Federal Reserve is raising interest rates in order to arrest inflation, in order to control inflation. But it does appear that because consumers are underestimating inflationary pressure, it could compel the Fed to raise interest rate even higher. And that tighter credit condition will ultimately burst the bubble. So we do have, in the current environment that we're in right now, characteristics of how the bubble is built and how they are burst. Are we about to have a financial crisis? This is simply a chart of the US Treasury yield spread. And it is the difference between the 10-year bond yield and the 2-year bond yield. And you notice the following. Every time the 10-year bond yield falls below the 2-year bond yield, the US goes into a recession. Where are we today? We're in the same position, where the US 10-year bond yield is lower than the 2-year bond yield. It's been lower for a while. So the US Treasury yield curve does suggest that we are going into a US recession. And a US recession would spread around the world. It will have significant impact around the world. Before I leave you on bubbles and crashes, I'd like to go back to that rhythm that Mark Twain was talking about. That history does not repeat itself, but it does right. So let me share with you the following pictures, if you will. This is the Singer Building that was completed in 1908. That was the tallest building at that time in New York. And the following year, the MetLife building was completed. At that time, those two were the tallest building in the United States. And what did they represent? They represented basically the spending, the buildup that led to the 1907 panic. So if you look at the Chrysler building that was completed in 1929 and the Empire State Building that was completed in 1931, they were built when there was a lot of money out there, there was a massive bubble out there, and they were completed during the Great Depression. And you can see the same example going around, right? That is the Tokyo building in Tokyo, and that was completed in 1990. And we know that there was a Japanese crisis then. And that was the Petronas Tower, right? At that time, the second tallest building in the world. All right, it was completed in 1997. And we know that was the Asian financial crisis. Right? And of course, in 2008, the Shanghai World Financial Center was completed. The Burj Khalifa was completed in 2009, and that was our global financial crisis back then. Today, we actually have, again, the second tallest building in the world, and that is found in Kuala Lumpur, the Merdeka PNB building, completed, and it's the second tallest building in the world. So clearly, the market, the world, has gone once again into building tall buildings. Very, very tall buildings that I think does suggest that there is excesses in the system created by this massive wall of liquidity that came from the United States that entered the emerging markets, fueling tremendous amount of asset price increase, fueling inflation, and now central banks around the world are grappling with that problem. And they have to come down hard, because if they don't, as we mentioned at the beginning, you get into a situation where if you don't control inflation, you will get into a crisis anyways. All right, we have come to the end of the analysis of whether or not we're about to have a financial crisis. Now, feel free to send your questions through Slido, and see if I can answer any one of them. Okay, thank you for sending all the questions through Slido. We got a first question, and it says the following. You've spoken a lot about the United States. What does it mean for the rest of the world, especially Asia? That's an interesting question. So there's a famous saying out there that say goes like this, right? When the US sneezes, the rest of the world catches a cold, right? And of course, the US is the largest economy in the world. Should it go into a crisis, should it go into a recession, there will be significant negative impact around the world, simply from the fact that very likely the demand in US will fall, and countries that are exporting to the US, countries that are dependent on the US for growth, will likewise slow down. Okay, so that is one thing. The US going into the crisis, if the US does have an economic crisis, it will probably send shock waves around the world. But that is not the only thing that matters. The other thing that's significant is how bubbles have been building around the world, right? And of course, we talk a lot about the massive wall of liquidity that the Federal Reserve has sent into the system. By system, we are not saying the system in the United States only. Typically, what happens is that when the US prints a lot of money, some of it gets invested overseas. Right? And a lot of the money could flow into countries like Singapore, Indonesia, South Korea, anywhere in the world, Latin America. And that wall of liquidity that get pushed out of the United States, finding their way in all these other countries, will also create a bubble. Are we experiencing some kind of very high inflation in this part of the world, in Asia? Sure, we are. As you can tell, a lot of the central banks here are also tightening monetary condition. They are also raising interest rate. But raising interest rate to fight inflation, of course, it's a double-edged sword, right? While it can control inflation, it will also increase the cost of doing business, the cost of investing, the cost of spending. And because of that, even inflation is somewhat difficult to control. You will find that central banks would tend to find themselves doing a lot more, raising a lot more, raising the interest rate a lot higher. And when that happens, of course, you get to a point where the cost of doing business, the cost of investing, the cost of spending, right, will overwhelm um, everything. And that will cause the system to crash as well. Okay, here's another question. Is real estate a good investment in this current environment? Well, if you think about inflation and how inflation seems to be difficult to control right now, then sure, if you invest in real estate, what's going to happen is that real estate prices will tend to increase together with inflation. In fact, all asset classes will do that, right? So if you think about stocks generally, right, stock prices will rise in a rising price environment, and so will real estate when general prices tend to increase. And that's because how does general price increase happen? Well, because of excess demand, right? More money chasing after less goods. And if you think about the environment where there is excess demand, what it all means is that people now find themselves, right, compelled or have the wealth or have the money to go out there and spend. And this generally happens, right, in a relatively good economic environment. And what has happened, of course, over the last few years is that we got massive wall of liquidity sent out by the United States to the rest of the world. We got government supporting a lot of spending, and that wealth effect creates a lot of excess demand, pushing prices higher, and it kind of spill over to, generally any asset class, including real estate. Now, don't forget, we're also in an environment that central banks out there are trying to contain that inflation. So at some point in time, if the central banks feel that they are having difficulty in containing inflation and find themselves having to push interest rate a lot higher, then mortgage rates will climb a lot higher as well. And when that happens, of course, it will send some significant downward pressure on where asset prices and real estate prices will be going. Okay, now, if you think about the following, if I want to fight inflation by investing in real estate, am I speculating, I should say, am I speculating, or am I investing, or am I, buying it for the long term? Now, because in a tightening monetary policy environment, it is not prudent for people to be speculating because the cost of borrowing is going to go higher. And as I mentioned before, if this cost of borrowing keeps going higher, then the the loan commitment, the service commitment that you make is going to go a lot higher. And that definitely does not bode well for investing, or I should say, that does not bode well for speculating in real estate. So here's the thing. Is real estate a good hedge against inflation? Sure. If you're investing for the very long term. Is real estate a good speculation in this current environment where central banks are tightening interest rate? Of course not. Okay, looks like we have time for one last question, and this is an interesting one. You sound so pessimistic about the global system. Is there a way that we can get around this? The major problem that we're facing right now is the inability to suppress inflation, mainly because inflationary expectations are constantly underestimated. And that forces central banks to do a lot more than they want to. But if you go back into the causes of high inflation in these few years, you will notice that beyond this massive wealth effect, positive wealth effect that was created by the central banks and the government to combat this pandemic, the other causes were mainly, to some degree, due to supply issues. So it started off with the pandemic and the supply chain disruption. You got the Sino-US trade tension. And then, of course, you got the geopolitical tension that's created by the war in Ukraine. Now, what if all these other factors start to turn for the better? In other words, as China opens up, it's able now to increase its manufacturing capacity. Everything comes online, the supply disruption abates, and they're able to then export to the rest of the world again. And on top of that, if the trade tension between the US and China starts to alleviate, starts to get better, it means that goods from China can now flow much more easily to the US. That will also reduce costs. And last but not least, of course, if we get a quick peaceful settlement in Ukraine, that could reduce significantly the price of oil and suppress inflation. So while excess demand caused by that positive wealth effect has resulted in this massive inflation that we're seeing around the world and compelling central banks to raise interest rates significantly, there is also the supply side that can come in, that the increase in supply can now close that excess demand gap. If we get that, then central banks may not need to hike interest rate by so much anymore. And if that happens, we could get actually a soft landing, which is not too bad, right? So, okay, generally, if we don't get that alleviation of supply tension, right, then that demand, that underestimation of inflation will consistently put upward pressure on inflation, compelling central bank to raise interest rate even further. But if we get that pressure off on supply, right, we will get a soft landing, and that is a good thing. All right, ladies and gentlemen, thank you for your time. We've come to the end of the presentation. Keep those questions coming on Slido, and I will answer them offline.